Good afternoon, everybody. Welcome to another self-directed IRA Saturday edition. We're excited to be here. We're excited for the presentation we have today in the webinar. My name is Andrea Chacin, and I'm an IRA specialist here at Quest. I would like to go over a couple of slides as we always do at the beginning before we go ahead and get started. But again, super excited for today's class. Thank you all for being here and for joining us. First off, as you may or may not know, if you've joined us in the past, we go through this disclaimer. Very important. Quest Trust Company does not provide tax, legal, investment, or structuring advice or endorse any products, services, or investments of any type. All information and materials shared today are for educational purposes only, and all parties are always encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. I would like to share this QR code with you guys. If you have any questions for any IRA specialist, if you'd like to go over the process of how it is like to invest with a self-directed IRA, we're a group of about 7 IRA specialists that would be happy to talk to you, educate you, send you more material if you need any, and kind of keep you there informed and whatever you need. Self-directed IRA investing related, of course. So go ahead and scan this QR code and book a consultation with one of us next week if you need to reach out. I would like to talk to you guys about our Gold Family experience here at Quest. This is something that we've been featuring because, we've had it for a while, but we really feel that a lot of you guys out there would really benefit from this. This is if you're going to be having upwards of 10 accounts, including, of course, immediate family members. It's a great concierge style of service. You have that one-on-one special treatment with a special inbox, a phone number, and you'll even have private events just for you. You'll have priority funding and priority treatment just in general for a fee that, again, if you have, I would say from 5 to 10 accounts, you can really take advantage of this. And it wouldn't even cost you more. It's just a flat fee for all of your accounts together. So go ahead and check this out if you're kind of there. If you have multiple accounts, it'd be something you can benefit from. Now, this promotion we're running for one more week. It's the rewards for deposit. If you are a new client or existing client and you move in funds into your Quest account, this is what you'll get. So you get $125 if you move between $100,000 and $300, $255 in credits if you move upwards of $300,000 to $600, and then from $600 to upwards, then you get $500 credit into your account. So if you're looking and you've been waiting for any reason to move funds into your Quest account, now is a good time to do so you can get these credits, okay? Last but not least, before we bring our speaker up here, I want to go over our Quest decks. But remember, we're running early bird tickets, which means you'll save $100 per ticket until the end of this month, okay? Until the end of December. So if you know you're going to go, which, I know a lot of you are going to go, most of us will be there, go ahead and buy it now because you'll be able to save for you and whoever is joining you, okay? So take advantage of this. Again, this runs until the end of December. December 31st is the last day for early bird, okay? And that's it for now. I'd like to bring up our speaker now of today, Don Pendleton, sorry. Super excited to have him. Hi, Don, how are you?
Oh, great. Thank you for the opportunity. I'm excited to teach.
Of course. Let me bring up your slides, and whenever you're ready, go ahead, take it away.
All right. Well, thank you very, very much. We've loved our association with Quest, and we love your students. We love the entrepreneurial spirit that you have. So let me kind of cut through the introduction. I'm going to go really fast. There's so much we want to talk about today. So here's kind of an overview. Well, first of all, we run the longest running asset protection class anywhere in the nation. We're starting on our 25th year of teaching. We teach a 3-day asset protection summit. The the theme of the class is a lifetime to accumulate, 3 days to protect. Give us 3 days, and we're really good at teaching the basics of asset protection, tax reduction, estate planning. So I'm not an attorney, but I've written 5 textbooks for attorneys that's used all over the nation. I've run a hotline now, again, starting 25th year of doing this. And I've been exposed to almost every kind of question that you can ask me about tax and legal, and so that's kind of our background. We've taught some amazing summits over the years, and I've been a guest speaker at multiple real estate conferences, and I'm not. It's not just me. We're aligned with some of the smartest attorneys in the nation. When we teach a class, for instance, we've got the former senior trial attorney from the IRS who left the IRS and has now turned around and sued the IRS over 2,000 times, doesn't lose cases. Bill Danko, I don't know anybody that's a better expert on millionaires. What the co-author of The Millionaire Next Door, he's got a new book out, Richer Than a Millionaire. We got here's people who know how to make and protect money. And so that's kind of who we're aligned with. We call them America's defensive coordinators. We've had some amazing speakers over the years. And that's kind of what we do is we teach tax and legal. As Andrea mentioned, there's a disclaimer. Not everything I talk about is going to apply to you, so meet with a professional. And she did a great job, so I'm not going to go over that. If I were to summarize what a real estate investor, what I consider to be for the 4 financial tornadoes for real estate investors, I would consider them and break them down into 4 categories: income taxes, lawsuits, probate and estate taxes, capital gains, those 4 things. And so we're going to kind of tackle those a little bit. What they've really asked me to structure this presentation on is legal structures for real estate investors. So I'm going to hit the first 3 very, very lightly. But taxes, I'm going to spend a little extra time, just a little on that, because taxes for a real estate investor, they say you make you make money as a real estate investor in the buy. And I would probably have an issue with that. I think you make money with the tax structure. I don't care if the buy, you could be off 10 or 20 or even 40%, but the taxes can absolutely kill you if you don't understand the tax traps that are in the tax code for unintelligent, sorry, I was going to say stupid, investors. You're going to lose the game. It's the taxes that are going to make a break far better than the buy. Both are important. I get that, but you have to understand the taxes. Let's tackle tornado number 1 is income taxes. You have to stop thinking you're winning the tax game because you got a refund. It has nothing to do. If you got a refund, means you overpaid. That's all it means. You need to start tracking your effective tax rate. Look at the effective tax rate of some of the people we've got. But the effective tax rate is take the tax you paid divided by the income you made. That's all it is. And if you see your effective tax rate going from 20% this year to 15%, well, you're good. Look at the tax rates of the people who are W-2 employees like LeBron James. 34% state and federal taxes as opposed to Elon Musk and Bloomberg and Buffett. It's those who have a business and understand the tax code. And yes, they pay billions of dollars. I get that. But that's what the IRS considers their fair share because they paid what the IRS says that they do, but they're very, very savvy in understanding the tax code. The biggest thing that I think most of our students are missing is that they're not understanding how powerful um, the IRA accounts, the qualified accounts, and partly because of our education system. We teach people, oh look, you could put $7,000 into your IRA, and if you're over 50, you got gray hair, then you put $8,000, and we look at it and go, it's not worth my time. That's not going to make a retirement account. But a SEP plan is $69,000 year after year after year after year, plus the growth that happens. That's how we build retirement accounts. And those first four, the IRA, simple SEPs, 401ks, are called defined contribution plans, because the IRS is defining the amount that you can contribute. But there's also things called defined benefit plans. I helped somebody last year put $300,000, an expense from her company. Company doesn't pay taxes. It's tax free to her because it's going into her defined benefit plan. Oh, baby, there's some really cool programs out there once you become savvy in the tax game. I've taught the last time I was here, I think last year, I taught about real estate losses, because that's another powerful tool that a lot of our students aren't understanding, the power of real estate losses. I went through an example with you last year where we could take a $600,000 investment. It doesn't matter whether there's mortgage, whether it's leveraged or not. That's $600,000, and then claim it as a $305,000 loss in real estate, which wipes out all of your other investment income up to $3,000 of W-2 income. These are powerful strategies. This is how Trump says, I don't owe taxes because I've got so many losses carrying forward from previous years. We can teach you how to do that. But real estate losses, I never want you to lose money in real estate. That's not the issue. But what the IRS considers as a real estate loss, that's a powerful tool. A lot of you are not claiming 100% of your medical expenses because of the wrong legal structure. If we had somewhere in your mix a C corporation with proper language from Section 105, the Internal Revenue Code, we could deduct 100% of your family's medical expenses starting $1. And a lot of you aren't understanding the power of that. Medical expenses, yes, but also health savings accounts. What they're not telling you is, yes, you know that a family can put money into a health savings account, but what they're not telling you is I can use these accounts to self-direct. And Quest is a really good custodian for not only IRAs, but also health savings accounts. So that could, your health savings account, it's not a use it or lose it plan. You can build it up and get it bigger and bigger and bigger and use it to invest and to partner on a real estate deal. And almost I don't have a lot of money in there, but maybe 10% of the deal goes to your HSA plan. Oh, baby, we're using these HSA plans to build wealth. Absolutely. And what I love about the HSA plan is that it's a triple tax-free environment. You get the tax deduction for the contribution, you get tax-free growth, and it's tax-free when you pull it out, as long as you're using it for medical expenses. And there's a certain age where you can just start taking it out. Love HSA plans. Another little tax tip: a lot of you aren't paying your children and grandchildren nearly enough. You're paying the taxes and then paying for their soccer camps and their cheerleading, and you're paying for their piano lessons. And no, shift the money to them, shift the tax burden to them, because this next year in 2024, you can give a child $14,600 without them paying a dime in federal income taxes. Are you kidding me? So we shift income to non-existent tax brackets. It's a great tax reduction strategy. Entertainment expenses, most of you know we can't deduct entertainment expenses. But did you know that team building activities, I can do that. I can do holiday parties, I can do annual picnics, summer outings. Those are tax deductible, just not it could be the same event. It's how you call it, how you label it, how you give the information to your accountant. Another example of that is a lot of you think, well, meals this year are only 50% tax deductible if I go to a restaurant. That's true. But did you know that catered meals, meaning it was delivered to you, don't stop by Pizza Hut and pick up the pizzas, have them delivered. Now it's 100% tax deductible because it was catered. Office snacks, per diem. It's understanding the tax code. Look, I'm not making up the rules, but I spend enough time to learn the rules to take advantage of them. Home offices. If you have a home office, if you don't, if you're a real estate investor, take this square footage. Maybe it's a small, but this is exclusively used for business. Let's say it's 12% of your home. Now I can write off 12% of my mortgage, insurance, property taxes, repairs, maintenance, landscaping, all of these things. It's a great tax deduction for real estate investors that I know that a lot of you are missing. Keep track of your mileage log and watch the IRS, because later this month in December, they're going to announce the new mileage rates for 2024. But take advantage of that. And sometimes you think, well, I win the tax game. I'm looking for big things, the cost segregation and passive losses. No, sometimes you win the tax game by nickel and diming the IRS together, and you'd be amazed by keeping a mileage log how quickly that adds up. Cell phones. A lot of you are not deducting your cell phones because your tax professional said no. Then you'd have to keep track of every call, and 63% were for personal. No. If your business requires a cell phone, can you imagine a business in the world that doesn't require a cell phone now? If your business requires a cell phone, according to this IRS ruling, it's right there on your screen. It's in 2011. Oh, that's 12 years ago. 13 years ago, a business can provide it without the need for record keeping. Same thing applies to internet. Look at great big companies. Anything that they can provide for their employees, you could provide for your employees if you're structured correctly. What we're going to do at the next 3-day Asset Protection Summit is spend probably at least a third of our time talking about tax reduction strategies. I'll tell you a little bit more about the summit later, but let's get on to tornado number 2, probate and estate taxes. Again, I don't want to take a lot of time. I'm only going to mention this. Let's say I picture your revocable living trust as like a great big Tupperware bowl. All of you have one somewhere in the cupboard. I don't care if it's green or red or yellow or clear. It doesn't matter. But you all have one, but you never stick it in the cabinet empty. You always put all the little Tupperware bowls inside of it, shove it away, and go, there it is. Picture that as your revocable living trust. Yes, you're going to own a corporation. Yes, most of you know that your house probably ought to be retitled in the name of the trust to avoid probate when you die. That way there's clear title to the property. You died, but the trust didn't die, and the trust carries on. And so most of you sort of understand that your bank accounts, your brokerage accounts ought to be retitled. Your investment properties probably ought to be retitled in the name of the trust to avoid probate. A trust is a great probate tool. Your vehicles could be titled in the name of the trust. Where a lot of you don't understand is that I could make my IRA. My IRA was set up for me when I retire. I get that. I've listed my wife as the beneficiary, but what happens if she's not there? Do I dump it right on the kids? Well, what if they're not old enough? What if they're not smart enough? Do I want them to receive all that IRA money if they're in a bad marriage or if they've got an IRS lien? No, I don't. I don't want them to get an inherited IRA right away. So I make the revocable living trust the contingent beneficiary, and it's in that trust that I establish all of the family values. We believe in education. We believe in military service. We believe in traditional family. I don't care whatever you believe. Here's what we do, and here's how you're going to get money out of the trust, and here's when you're going to do it. And there's spendthrift clauses. So if the kids move into a community property state, spouse doesn't inherit half of what they have. If they're in a bad marriage, the trustee can't distribute until that goes away. we use this revocable living trust. Most of you understand that life insurance can also be dumped into the trust. I made my wife the beneficiary of my life insurance policy, but the trust is the contingent beneficiary. Okay, and most of you sort of understand the trust at that level. But let's go to a whole new level. I helped a lady here, it was probably 3 or 4 years ago. Her husband had died, leaving her as a 38-year-old widow with 4 little kids. They owned a water drilling company down in Texas. It was worth about $4 million. Oh, wait, they didn't own it. He owned it. It was a single member LLC. Who owns it now? Well, it's going to do, because there's no clear title to that, it's going to go through Texas probate. And after 9 to 12 months of Texas probate, it may not be, that company may not be worth $4 million. We always tie your business interests. You've got 40% of this corporation, 60% of this LLC, 100% of this LLC, the limited. We always tie those interests to a succession plan, so that when you die, your interest in the corporation doesn't go into limbo somewhere. Oh, we didn't understand that. And a lot of you are missing those pieces. We always tie those things down to a succession plan. We're going to spend a lot of time, probably about 2 or 3 hours at the next 3-day summit, teaching you how to not only create the trust, but how to fund it properly so that all of those assets avoid probate. There's clear succession to all of those. I hope that that will be very helpful for you. Tornado number 3. Capital gains taxes can kill a real estate investor if you're not savvy enough. And so at the next summit, we're going to cover multiple ways how to. You're here with Quest Trust. Great. Retirement plan. Perfect. That's one great way to avoid capital gains taxes. But 1031 exchanges, do you know that I could take all my real estate when I'm 70 years old? I don't want to do real estate anymore. I could 1031 exchange, let's say, into oil and gas field and passive income. And you can 1031. Yeah. Oh, you know, there's a thing called upstream planning. Okay, my dad's 90. If I gifted him this commercial property, as long as it's under $12 million, $13 million this year, oh, there's no gift tax. I've got to file a gift tax return, but there's no taxes. Okay, so I gift him the property in 2 years, and I title it with a transfer on debt. So as soon as he dies, it's going to come back to me, but it comes back with a step up in basis, and I avoid capital gains taxes. There's so many things that we can do. There's family foundations. There's some businesses up to $50 million. You can avoid capital gains just by having the proper structure when you set it up. It's called qualified business stock. There's a lot we can teach you about capital gains avoidance, but capital gains avoidance, if you don't understand that game, will kill a real estate investor. Okay, but here's what we wanted to spend the bulk of our time doing, and that is talking legal structures and how to legally structure, especially things that are non-qualified, so non-IRA monies. How do I take my real estate and structure those? You need to know where the sources of lawsuits are going to come from. The majority of lawsuits are going to come from family members. It's going to be divorce. Divorce is a form of a lawsuit. There's so many things that we can look at, but if you're owning investment properties, and we could spend hours on this one slide, and it would be very well worth your time to do that, to know where the sources of lawsuits are coming in this ever-changing environment that we're in. We're really good at following the current trends of lawsuits. But if you're owning investment real estate, let me show you where your lawsuits are going to come from. 64% of your lawsuits are going to come from number one, keeping your tenants safe. If there's an assault on the property, who are they going to sue? The 56-year-old guy who assaulted your tenant, or are they going to come after you? Well, he's living in his mom's basement because he can't keep a job at the 7-Eleven. They're going to come after you, and they're going to subpoena all your records. They're going to look at anybody who ever came in, all your applications, why did you let this person in instead of this person? They're going to look at your window locks and your door locks and the lighting in the parking lots and the shrubs around the building. And what they're going to look at your records and see if they can pierce a corporate veil and come after you personally and come after your home and your retirement accounts and anything else. You need to know that tenant safety is your biggest issue. But there's also things called statutory liability. That one scares me the most because by statute, if there's mold and mildew, if there's lead-based paint, if there's a chemical spill, I don't care if you've ever, I didn't know about it. It doesn't matter. I warned the tenants. It doesn't matter. I don't care if it happened 20 years ago and I didn't own the property. If you're entitled to any of these things, by statute, you don't get a chance to defend yourself. They're going to come after the deepest pocket and they're going to make you pay. I want you to have good insurance. Okay, that's an important thing. But understanding the game and where the lawsuits are coming from is really, really important whenever you're owning investment real estate. Yep, 64% of your lawsuit statutory liability is the one that scares me the most. Okay. And so a lot of you are going to your advisors, and they might be CPAs, they might be your best friends, they might be other investors. And the number one stupid advice that I hear from people is just carry more insurance. Let's have an umbrella policy, and that covers, now I got $1 million, I'll get $2 million, I got $10 million. What you're not understanding is what insurance doesn't cover. Read your flipping policy. It's not going to cover mold and mildew. I don't care if you go to $10 million. It's not going to cover lead-based paint, chemical spills. I see this all the time in my investment properties. Whenever there's been a flip, whenever I've had to change tenants, it takes more than 30 days, but your policy says if it's rented for longer than 30 days, if it's vacant more than 30 days, we're going to deny that. I found that out the hard way with an investment property I had in Indianapolis. We were changing tenants. It took a little bit. It was on its 60th day. It needed a revamp, and somebody came along and stole our $6,000 air conditioner. Insurance company denied the claim because it had been vacant more than 30 days. If you don't understand the game, and here's what you also don't understand, or most investors don't, is that the umbrella policy will only pay if the primary pays. Carrying more insurance, millions of dollars more, just makes you a target, but it doesn't increase the breadth of your insurance. I'd rather you spend a little bit more coverage, a little bit more money on not covering the breadth or the depth, but covering things that wouldn't otherwise be covered. I always want you to have proper insurance, good insurance. And know that that's your first line of defense, but know that there's exclusions to every policies and limits to every policy, and that's why we do legal structures. So the number one thing that I tell you is really dumb advice is to carry more insurance. Second one I see is just carry land trusts, provide great asset protection. No, they don't. They provide a smoke screen, but if they get past that smoke screen and in a deposition, it's a revocable grantor trust, meaning it's changeable. It's like your living trust. There's no asset protection to it. It was just a smoke screen. That's all it is. And so we always take our land trusts and we put them in something stronger. Do your own repairs and save money is also dumb advice, because I have the legal structure, but I did the repairs, so I get sued and the LLC gets sued because I had faulty wiring, or I had the mold and mildew resulted, or whatever. And so now there is no corporate veil if you do the work and the repairs yourself. Yep, save money, but it costs you in the end. Failing to fund your LLC. I see this all the time. I've got the LLC structure, but I didn't transfer the property into my name because it was financed in my name and I was worried about the due on sale clause. So it's still, I got the LLC, it's all structured, but I never put the property into the LLC can only control that which it owns. If it doesn't own it, it can't control it. I see people all the time that hold all of their properties in one LLC. A guy called me at our hotline. I told you I've been running a hotline for 25 years. He called me 35 individual properties all in one LLC. Well, not really, because the last 6 he kind of was still in his name, but he was going to do that. Do you know that one property inside of that legal bubble can take down everything? Oh, I didn't know that. My accountant told me it would protect me. Yes, it will protect you from outside lawsuits, but it won't protect you from anything that happens inside of the bubble. That would be dumb advice. Having your revocable living trust. I just put all my investment properties into one revocable living trust. Well, that will save me. No, it saves you from probate, but it doesn't save you from lawsuits. The reason why is because it's a revocable grantor trust. I can move assets in and out and in and out, in and out. I always have access to them. If you always have access to them, don't you think the judgment creditor against you would also have access to them? Yes, they would. And so the revocable living trust is a great probate tool. It is not an asset protection tool. Let's put everything in a C corporation. All my investment properties, I say I put it in LLC, tax it as a C corporation. Great, you just lost all the tax benefits personally of owning real estate. They're all locked in a C corporation. Your depreciation deduction, I lost that. My passive losses, I lost that. I can't do cost seg. Well, the C corp can, but that would be really, really bad advice for most of you. There's occasions where there might be an exception, but that would be pretty rare. I see a lot of investors putting their properties into an S corporation, or I take an LLC, tax it as an S corporation. Great. Do you know that when you die, and this is a revenue ruling that came out right at the beginning of 2023, and the IRS has been on the line. They finally come out with a revenue ruling. It was Revenue Ruling 2023-1 that said if you own property in an S corporation, you are going to lose the capital gain exclusion on this, which means there's no step up in basis. If you die and all your investment properties are in LLCs taxed as S corporations, your kids are going to pay all the capital gains taxes. There's no step up in basis if you're using the S corporation. That would be dumb advice. Single member LLCs, do you know single member LLCs don't provide outside protection in 43 states? I'll tell you a little bit about that maybe in a minute. Or I use an out-of-state entity. I've got properties in Michigan, so I'm going to use a Delaware corporation. Well, if damage is done in Michigan and the properties are there, your bank accounts are there, why does Michigan court have to honor Delaware laws? They don't, and they won't. And what's going to happen is because you have no standing in the state of Michigan, you didn't file your entities in Michigan, you're going to show up in court someday to defend yourself. The plaintiff's going to be on his side of the table, you're going to be on your side, and it's going to be a quick gavel coming down on your little head and going, look, the defendant didn't even show up. Yes, I did, Judge. I'm right. No, defendant didn't. You have no standing in this. Therefore, summary judgment for the plaintiff because the defendant didn't show up today. You have no standing in those courts when you're using an out-of-state entity. We use out-of-state entities, but only as a nesting tool. Oh, there's so much we can teach you. So here's the most common question we get on our hotline. Is we say that people call up and say, okay, I'm a real estate investor. What's the best legal structure for me? And my answer is going to be, it depends. And I'm not being flippant and I'm not being coy. I'm not avoiding but here's what it depends on. Are you want to flip or you hold? The legal strategy is going to be very, very different depending on what you want to do. Are you owning the title or the note? It makes a difference. One is safe assets, one is not. Are you using qualified funds? Are you using IRAs, 401ks, self-directed, I don't know, whatever you're using? Are you using qualified funds, or is it makes a difference for me? Are you using leverage? How much leverage are you using? Are you using other people's money? Did you go out and did you seek other people's funds? Because the legal structures can be different. Where do you live? Where do you invest? Are all of your investors US citizens? What state lines are you crossing? Are all of your investors US citizens? All of those things make a huge difference. And what I'm seeing is a lot of really dumb advice, mainly from your accountants that go, oh, just set up an LLC. Well, that could be really good advice, but it might be really bad for you depending on your tax structure. Okay, let's just take the very first one, because that's the easiest one for me to show you. The others get a little bit more complicated, and let me show you the issues. If you wanted to hold the properties, here are the issues that I see. I'm worried about resident safety. I'm worried about property managers, maintenance, protecting your equity. I'm worried about simplifying your paperwork. If you have 10 investment properties, do you need 10 LLCs? Well, that's 10 filing fees. It might be 10 bank accounts. It might be 10 tax returns. Let's simplify this. I'm worried about a due on sale clause, because if you get the property in your name using your financing and you transfer that out of your name, the bank says they're going to call the loan due. It's right there in your paperwork. Every loan, every commercial loan ever since 1977 is going to have that due on sale clause. Well, how do we avoid that? I'm worried about losing depreciation. You know, if you use the wrong legal structure, they're going to deny your passive losses, which means, okay, I got 10 properties. 7 of them are making money, but 3 of them kind of lost money this year due to depreciation, repairs, I don't know, maintenance, lost money. And I want the income to offset the expenses. I want to take the losses and write those off. And you got the wrong legal structure. And the IRS goes, no, you can't do that. You're going to have to claim all this as income, and you can't, and we're going to deny the passive losses. Oh, it's all dependent on your legal structure. But if you're flipping properties, here are what I consider to be the issues. Construction liability, subcontractors not getting paid, buy-sell contracts, capital gains. Oh, and dealer status. Dealer status is one of the worst of all, because if you're flipping on one side and you're holding over on this side, I've got 3 rental properties, but I'm also flipping actively. Then the IRS comes down and put a label on your head saying you're a dealer in real estate. That means for the next 3 years, you're going to lose all the depreciation deductions on all of your properties. You're going to lose the ability to do a deferred sale. So if you sell a property, and let's say you're going to receive money over the next 5 years, the IRS is going to make you claim all that income right now, even though you don't have it, and pay the taxes, the capital gains on all of it. You're going to pay 15.3% self-employment taxes on all of your gains, even and all your rents. Oh, it's passive. No, you're a dealer in real estate. You flip this house and you do it in the wrong legal structure. So we always flip and hold. If you're going to, we hold properties in no, I'm sorry, I said that wrong. We flip properties in LLCs taxed as S corps or C corps. We hold properties in disregarded entities or partnerships, and we don't mess that up. Let me say that again. We flip and hold in C and S corporations or LLCs taxed as such. We hold properties in things taxed as partnerships or disregarded entities, so that you're not the dealer in the real estate, the S corporation is. I hope you're understanding that that's a big deal. If you flip a property and you do it wrong, it's going to cost you a lot more in taxes than you ever earned on the flip. And the IRS knows that, and they watch for that, because the concerns are different. Let's go back to the legal structures. Flipping and holding, very different because the concerns are different. Don't you think the legal structure that we would advise would be very, very different? And the answer is, of course it is. There's two legal definitions I want you to understand. And then, you know what? I'm going to breeze this real quick because I want to show you some diagrams first. But you need to know the difference between corporate veil and charging order because they're very different. And most investors get that screwed up, and a lot of attorneys get that screwed up because they don't understand the difference. And almost every accountant screws this up. The corporate veil protects you from the business. So let's say a lawsuit happens in your business, whatever the business is. What you want is you want a proverbial brick wall between you and the business, protecting your assets, your cars and your rental properties and your retirement accounts and everything that you own. The goal here is to attract and contain all the risk inside of that business, not let it leak out to the officers and directors. There's two types of corporations or two types of entities that we use. That's corporations and limited liability companies. And I don't care whether it's a single member, multi-member, I don't care if it's manager managed LLC, I don't care what it is. The LLCs have the ability to contain risk if you're playing the game right. If you're keeping up your corporate formalities, you're paying your taxes on time, you pay your filing fees, you do whatever is legally required. If it's a corporation, you're having your minutes and meetings and resolutions and not commingling funds. And all of those things are important to have corporate veil protection. Critical that anytime you have an operating company or a business, real estate management company, we have good corporate veil protection. Now that's very different. Oh, and look at this. The Cornell University came out with a study saying 67% of small businesses could be pierced because they're not doing it right. We're going to spend a lot of time at the summit talking about how to keep up your corporate veil and keep that liability separate so that your stuff is safe and protected. Now, that's very different than charging order protection. Charging order is when you personally get sued. And now they're coming after the ownership of your business. Now they're coming on after your home and your retirement accounts and your automobiles and all that stuff. But also, can I take over the ownership of your corporation and your LLCs and your limited partnerships? Charging order it protects your business assets. There's our goal, is to protect your personal assets and all of your business interests. I own 40% of this business, 100% of this. I don't want to lose those in a lawsuit. And so what I'm looking for is really good charging order protection. And that's going to come from multi-member LLCs, more than one member. Single member LLC doesn't quite work the same, but multi-members because there's innocent parties and family limited partnerships. I always use those for real estate holding companies. Not necessarily a management company, but anything that's going to have assets to protect. I want strong charging order protection. Charging order protection, the purpose of it is to protect innocent parties. Let's say one of these girls here in this beautiful little singing group gets sued. Okay. We're going to pick Jody here on the right side. She gets sued. Is it fair that we allow a judgment creditor to come in and take all the assets from the whole partnership? Well, no, because there's three other innocent, beautiful girls that would get hurt in the process. But what if it's just her? What if this is a single member LLC? Does charging order apply to that? And in most states, it does not, because there's no innocent parties. It's just Jody. Why not take all the assets, dissolve the partnership? It's really just an alter ego of her. And the answer is, can single member LLCs provide charging order protection? And the answer is yes, if it's in the right states. I don't have time to go through all the case law that supports that, but know that we have it. And it's very important. So there are 7 states that now provide charging order protection for single member LLCs. Most of yours don't. California does not. Texas is not on the list. up until 2 months ago, and now Texas joins. Welcome to the party, Texas. Now they are offer charging order protection for single member LLCs. If you've got properties in Florida and you put them in single member LLCs, and I sue you personally, I'm going to walk through and take those every time because the courts in Florida say that I can. See that? You need to know that because your accountants are just saying, we'll just have an LLC. And let's treat it as a single member LLC. There's no tax return. It's really good, but it makes you vulnerable to any lawsuit that comes to you personally. I'm not going to go over this because I don't have time to go over essential clauses. Let me talk about basic legal structures. If you walked into a Marriott hotel or a Hilton or a hospital, here the legal structures are always going to be the same. There's always going to be two entities. One manages the property, one owns the real estate, and then there's what's called a triple net lease, shifting all blame away from the equity in real estate up to a management company that owns little bottles of water and it owns used bed sheets, and there's no attractive assets there. And then what we're going to do is we're going to shift as much money down where it's passive by nature and we're not paying self-employment taxes. So if you're going to take a salary, if you're going to take money out, yeah, you might take a small salary, but that's going to be subject to self-employment taxes. We want to shift the majority of your income down where it's passive and not paying self-employment taxes. Great tax strategy. And then we tie everything down to your revocable living trust. We take your ownership of the LLC or of the operating company, and we tie that down to your trust. So if this is a corporation, we title the stock certificates in the name of your trust, not in your name. When you die, who owns the corporation? Well, clearly the trust does. We take your ownership interest of the LLC and we tie that down to the trust. Do you see what we're doing? Is this cool? We take all the tax advantage you can possibly suck out of your corporation. That's a beautiful thing, but it doesn't own assets. If it ever gets sued, it doesn't own anything. It no attractive assets. We put all the assets at where they're passive by nature and protected by state law. Okay. If you have multiple properties, we separate those sometimes in multiple LLCs, but the structure is the same. The problem with this is that it's going to require 5 tax returns. Your personal 1040, one for the corporation, one for each one of the LLCs. That's 5 tax returns. If we simplify that, we can do that using single member LLCs. Wait, Don said single member LLCs are bad. No, when you own them, you don't own them. They're held in a really strong multi-member LLC, maybe in a really strong state like a Wyoming, Nevada, Delaware, Alaska. Ooh, we put those in a really strong state, and it makes, if I personally get sued, they're going to come find me in Wyoming if they can find me. And Wyoming offers anonymity that the other states don't offer. Oh, see what we're doing? Oh. So each property or small groups of property are protected, and those are filed in Michigan, or if the property is in Indianapolis, we put that in Indiana. If the property is in Florida, we put those in. So I have standing in the state. So the single member LLCs always filed in the state where you're doing business, all held in a Wyoming, let's say a Wyoming holding company that's impenetrable to lawsuits. Everything ties into your trust. I use a corporation to manage everything. Do you see what we're doing? Oh, baby. But what if some of my money is in, I've got extra money. I've got $1 million in bank accounts and brokerage accounts. I might put that in a separate LLC. What if some of my money is in IRAs? Okay, so I use the same structure, but then IRAs are separate. I don't tie that in to a management company. If my C corporation is managing my IRAs, that would be a prohibited transaction. Don't do that. That'd slap you. And we don't always tie in your IRA to the trust because the IRA is a trust. It has beneficiaries. That's what it falls under trust rules. And if I have multiple properties, I use multiple IRAs sometimes. By each property or small groups of properties in a separate IRA. Could I do that? What if What if Quest is charging me way too much money for each IRA? Well, they're not. But if they were, then I would use single member LLCs inside of the IRAs to hold the properties. I wouldn't do this, let's say in California, where they're going to charge $800 per LLC. I would have more IRAs. I wouldn't do this in Massachusetts where they charge $500 annually. But if I were in, let's say, Missouri, where there's no annual filing fee, once I set it up, great, I would use LLCs instead of more IRAs. See, the legal structures are the same. Here's what I don't have time to talk about. I'd love to share so much more. I went way too fast. I covered way too much. I'd love to talk about some state variations. For instance, that $800 extortion fee from California per legal entities. How do we avoid that? Oh, we're good at that. Arizona, where a land trust has to be, we have to disclose the beneficiary. In Pennsylvania, that your stupid real estate transfer tax of 3%. How do we do things differently in Texas, where it's series LLCs are growing strong in popularity? Do we do things different in Florida? Yes, we do. And every state has different variations. And so I gave you some general rules, but there's always going to be state variations, and we're very good at this. What if I've got a partner in my real estate and I really need the tax losses and I'm willing to give up some of the cash? I'm not cash heavy. I just want those real estate losses and the depreciation. Could I structure the deal where it's not? Oh yeah. Oh, we're good at this. Income tax ideas. I only spent 20 minutes on taxes. There's so much more we can teach you, and how to create anonymity in your legal structures, the best states to incorporate, the effective use of land trusts. There's so much more I'd love to cover. I'd like to invite you to America's premier 3-day asset protection summit. We've worked out a deal with Quest. Now that this is a live stream event, we can offer it for free to Quest people. So here we go. Amazing offer. This is a 3-day asset protection summit. What I'd like you to do is go to protectwealth.com/live stream. This is kind of a special offer for Quest. And sign up for either the January 22nd or the March 6th. Remember the theme of our class is a lifetime to accumulate, 3 days to protect. We've got the best experts in the nation on asset protection. We're bringing it. We cannot make this any offer any better, but you have to give us 3 days. And why I say that is if you come in and learn half a strategy or half a legal strategy and think you're all powerful, you're going to muck this up. I don't want you to do that. I want you to take advantage of the tax code. I want you to protect yourself and your family, but do it in the right way. We're offering you a great opportunity to do that now. Hit protectwealth.com/live stream. And you'll see when you do that, the agenda is not a wussy little agenda. We cover a lot of material, not as fast as I did today, a lot more thorough. And we have a lot of attorneys in the background to answer your questions. And I'm sorry I went so fast. I would like to open this up to Q&A, but do take advantage of this opportunity. Andrea, did I go way too fast?
No, we're perfect with time right now. Thank you so much, Don. That was amazing information, and I highly encourage everybody to join the 3-day summit, because wow, even myself, I'm going to join as well. So much
Good.
to learn. Thank you so much, Don. Now there's a few questions that already came in, and please, anybody who has more questions for Don, now's the time to ask them. But I do want to also ask you if there's contact information, Don, that we can maybe share. I can put it in the chat if anybody wants to contact you or anybody in your firm for any help or anything like that.
We are all over the internet.
Okay. So just go to your website.
We've got hundreds of YouTube videos. So you go to YouTube and there's Protect Wealth Academy. We're all over Facebook. You can like us and subscribe. But our company, I don't know how to share that, but we've got our website has our our phone number on it all
Okay.
over. Do you want that number and
No,
post it?
I can just put the website in the chat, protectwealth.com.
Yes.
Perfect. I'll
Yep.
do
It's
that.
real easy. And then my email is donp@protectwealth
Okay.
and .com, and our phone number is published on everything that we do. It's an 800 number. You're welcome to call it. We do run a hotline. We do answer questions.
Excellent.
Yep.
All right. We have a couple of questions. Let's go try to go over them. Actually, one of them is a comment on your HSA slide that it should say over 55, not under. Thank you, Tim, for that. Timothy
Oh,
Deacon.
what I was trying to do is on that is put equal to it, or oh no, that was another one. So I'll look at the slides and see if that's wrong. Thank you.
Yes, but that was really awesome. I love when you talked about HSAs. That's one of my favorite.
Yes.
It's not an IRA, but an account. Yes, for sure. That we offer a Quest as well. So, from M. Musa, is there a way to shelter stock sales from paying capital gain taxes?
Yes. If we, so if you're holding that in an IRA, there's no capital gains taxes. Once you have it in your own name, in your own brokerage account, we always encourage you to look at exchange traded funds rather than mutual funds, because they avoid capital gains taxes. They didn't tell you that, but they do, and the fees are a lot less. Once you have them, you can't really 1031 exchange like you can real estate. But what we can do is we can offset the capital gains with a real estate loss. Let's say you're flipping a house this year, and between the repairs and the depreciation, you have $100,000 loss. That might very well take over your capital gains. And even though it's not exactly the same, you didn't avoid the capital gain, you offset it with a real estate loss. And so we look at that often. We have real estate stock market investors that consistently make over $1 million in the stock market, but they always buy a real estate property every year, flip it, just because of the real estate losses that offset their capital gains taxes. Oh,
Wow.
yep. Always,
Interesting.
always.
Very interesting.
Yep.
That's really cool. I didn't know that. That's awesome. Thank you. From Norma, she also just did more of a comment. I missed the first part, and I want to see this 3, 4, 5 times because this is gold. Thank you, Norma. You'll be able to watch the and watch it as many times as you want. It'll be posted on our YouTube channel. We have a question from D4. If I personally get sued and lose, can a creditor get access to my revocable living trust assets?
Yes, they can. Because it's revocable, amendable. I can move the assets, let's say my home, in and out, in and out, in and out 15 times a day if I want to. You always have access to the assets in revocable trust. Therefore, a judgment creditor would also have assets or access to it. And so we do some special things. I'll spend an hour or so at the next summit talking about how to protect your personal residence. We look at your homestead laws. We look at, Texas, Florida protects 100% of your home, but I live in Utah. Utah only protects the first $30,000 equity in my home. Pennsylvania will only protect the first $300 equity in your home. Are you kidding? It's an archaic law, but they haven't updated it. It'll protect your front door. So we look at protecting your assets. So we might use, let's say, a personal residence trust in Pennsylvania. But then that's owned by your revocable trust. We own rental properties in LLCs that are then owned by the trust. So although the trust doesn't provide anything but probate protection, we use layering, and everything comes down into that big Tupperware bowl called your revocable living trust. Does that make sense?
Mm-hmm.
I hope so.
Yes. A couple more questions. I'm doing my first flip to you have a started program that I can scale later as needed. I don't know if
everything that we do and everything that Quest does is scalable. Can you flip inside of a IRA? Yes, you can. And if we need two IRAs later and we need an HSA play, everything that we do you need a corporation to flip a house? No, you don't. Could you have start with one LLC? Yes, we could. And as you acquire more investment properties, everything that we do is scalable. Always, always, always. We wouldn't do anything that wouldn't be.
Excellent. We have, what's the relationship between Quest Trust and Protect Wealth?
We're good friends. We look for the best people in the industry, and Quest not only is a really, really good custodian, but they offer education programs that we haven't seen anybody else. We've looked at their fees. We found them to be reasonable in the industry. They're not exorbitant, and they've got really good people. What's our relationship? They invite me on stage. We don't share anything back and forth. If you're on our stage and you see Quest, I don't get a piece of. I don't know who sets up accounts, and they don't know who does legal work. We just respect each other. How's that? Is that
I would say that's
Andrew? You want to add anything to that?
I would say that's very accurate. We share. I would say we're both big into education and outreach on education specifically, and so that's why we're great friends. Yeah, I would agree for sure. We have a couple of really good comments. This is great. Thank you. Great hour. Thank you, Don and Quest. See you at the summit. Thanks for the invite. Thank you, everybody, for the nice comments. Will we have access to the summit video for 3 days after completed for reference? Would you happen to know that, Don?
We don't. We've had too many people cut it up and try to. So no, we do record it for compliance purposes. We don't make it available, but we do cut up pieces. And again, there's so much information on our
Okay.
YouTube channel and on our Facebook. But we do want you to attend live when you come. Give us 3 days, and I know that's there. We always do our 3-day summits during the week. They're always Monday, Tuesday, Wednesday classes. I cannot bring the former senior trial attorney from the IRS. I can't bring the attorneys, the manpower that we bring on a weekend. It doesn't work. And I know that that's a sacrifice, but give us 3 days. I guarantee it'll be worth it for you. A lifetime to accumulate, 3 days to protect. Give us 3 days, and we're really good at teaching this.
Excellent. Can I move assets acquired on my name to my LLC without invoking due on sale clause?
The answer is it depends on how you do it. And there's also real estate transfer fees in a lot of states. And so you've got to be careful of both. So real estate, if you're transferring it into an LLC, and let's say there's a HUD or there's a mortgage on it or a Fannie Mae, they won't have a problem with it. It depends on how you're doing it. Sometimes if we have to, we'll use a land trust as kind of a bridge, so that they'll allow the transfer into the land trust. They have to. There's a Garn St. Germain Act, 1983-84. That prohibits them. And then what we do is we use the land trust. We assign the beneficial interest to the LLC. And so we always have a way around it, but depends on your state and your mortgage company as to how we do it. So I wish I could tell you carte blanche, yes, but sometimes it gets a little bit more complicated than that.
Makes sense.
Okay.
Thanks, but I was told real estate losses can't offset stock gains because it's passive losses versus active non-passive gains.
So we always make our real estate passive. You didn't manage the property, your corporation did. Therefore everything that I own is in the LLCs is passive. And the answer is if they're saying one's active and one's passive, then you're doing it wrong. but we can write off real estate losses if they're passive against, well, it'd be the other way around. Stock market losses, stock market gains against real estate losses, they have to be passive, both of them. And if one of them is active, let's say I'm a real estate professional and I'm doing everything as active. No, then we put a bridge. We make your corporation active and we make your real estate holding companies passive. The answer is absolutely we can, and we do it all the time.
Excellent. I mean, do you have a smaller program, less expensive, if I don't need multiple entities at this time? I'm not sure if I understand this question. Do you, Don?
Well, we start with what you need. And if you need one LLC, let's do one LLC. If you need one land trust, we start with one LLC. There's not necessarily a package that fits all. There's no legal structure that fits everything that we do. We're not going to start with everyone with a corporation, multiple LLCs, and IRAs and revocable living trusts. We start with what you need, and if the only thing you need right now is one Arizona LLC to protect your Arizona property, let's just do what's wise, prudent, and responsible.
Mm-hmm. We'll take one last question. How many transactions in a year would make the IRS conclude that you're a dealer in real estate?
Ooh, really good question, because there's a lot of people thinking, oh, that once you hit 10 properties, I flipped 10 properties, now I'm a dealer. No. There is no magic number. I flip one property with the intent to make a profit, and you get caught and you're a dealer in real estate. Let me give you an example. Several years ago, we lived in a cul-de-sac. We wanted to buy the house right across the street. It was going into foreclosure. I knew the owner. She had some renters in there that she was going to evict. They're not paying rent, but they're going to foreclose on her before. So I bought the property from her, sort of sight unseen, because the renters wouldn't let me in there. My intent was to get a bigger house and move my family in. But then when we evicted the tenants, we got them out. We found out that the basement was not finished, and the foundation was cracked, and the stairs had fallen away from the back of the house. And we found out it wasn't in a great condition, and it became like the money pit from hell for us. And to flip this property, and we did flip it, but the intent was not to flip it. Our intent was to move it into it. So had I bought it for that wrong reason, one property can throw you into dealer status. Let's say we had bought the property and I intended to flip it. And the next day up, there's a sign on it that says, for sale by owner, be ready in 2 weeks. I'm a dealer in real estate. There is no magic number to answer your question. It's not 3. It's 10. You may not get caught until there's 10, but by IRS standards, you're a dealer with the intent to flip one property. You're a dealer in real estate. Good question, because there's a lot of misconceptions about that. Thank you.
And then again, we have Musa, and we'll finish it off after this one, because I don't want to take too much time of everybody's time here. I want to be respectful of everyone's time. How can stock gains be defined as passive?
Well, I'm not actively managing IBM or GE or stock gains are always passive. I'm not actively. It's the real estate that gets muddled, because if I'm managing the properties, then it's an active. Or let's say, and a lot of our students got nailed on this a few years ago because they were using family limited partnerships to own their real estate, and the IRS came out with a ruling. I don't remember what year, I think about 2008 or 9, that says if you're holding your properties in, and this is real estate, if you're holding your real estate properties in family limited partnerships, you're probably the general partner. That's probably you. And so we're going to deny your passive losses. So again, you get 3 properties making money, you get 7 losing money, and vice versa. I don't care. If you're holding these in family limited partnerships, we're going to assume that everything is you're actively doing this. And so that's why we switched. Well, one of the reasons we switched to LLCs is because of this passive loss rule. But stocks are always, unless you're an active trader, which means you met active trader status, then your gains and your losses will always be passive. Once you cross that line, it's like a real estate professional. Once I've hit the 750 hours and I become a real estate, then there's some active loss rules, but capital gains passive losses in stock markets should always be passive, unless I'm a dealer. Okay, enough on that.
Awesome.
Andrea, it has been delightful to be here. Thank you.
It's great to have you, Don. I hope we have you again in the future also, and I hope to see everybody there. I will be there for the 3-day summit. Excited for that as well. Thank you, everybody, for joining us and for participating and for your questions. If you need to reach out to Don, please, I put his information in the chat box, so go ahead and feel free to reach out to him and his company, okay? Perfect. Thanks again, Don.
Thanks, Andrea.
Have a great rest of your weekend, everybody.
Bye-bye.
Bye-bye.